What it means is we're looking for areas of the market where we think that people are underappreciating the potential for recovery. Because what we think markets do is they get overexcited when times are good, and they get too pessimistic when times are bad. And that doesn't mean the whole market has to be good or the whole market has to be bad. Different sectors and different companies can be in and out of favor at different times. So I guess what we're saying is we're trying to avoid areas where the markets become exuberant, and we're looking for opportunities where the markets become pessimistic. Obviously, though, we're looking for the companies to recover from that low point. Well, really, what that means is we're not part of a big fund management group. We are directly employed by the trust, and the advantage is it allows us to focus all the time on the trust. I think the advantage as well that it gives us is we're not part of a big investing crowd. We can take a differentiated stance. We have less of the noise and pressure from working with the big market groups all the time. We can take a different stance, which is where we think you get the better opportunities. I worked through the dot-com era. It was a very interesting era. It was very exciting at times, and then of course it was very depressing at times subsequently. The thing I really remember at the time was how people would take a story, and they were stories that they knew in their heart of hearts weren't very good, but because the prices were going up, they were prepared to run with them in the anticipation that they would be able to get out before everyone else. Now, of course, not many people did do that, because actually it's very hard to do. And I feel, yes, we are back in that sort of mindset again today. There's been a number of high-profile unicorns listed, particularly in America recently. They've been very well covered, but they have very questionable business models. And in essence, they've taken market share by subsidizing their products, whether it's video streaming, leasing offices on a short-term basis, music streaming. And the long-term business models look poor because when they have to put their prices up to make money, presumably that's when the growth stops. So yes, but people are prepared to run with these because they think the share prices will keep going up. We don't want to get involved in that because we just don't see it ending well. By far the best performing area of the portfolio recently has been our gold miners. Now, gold miners have been out of favor for a number of years, really since the Euro crisis of a number of years ago was at its peak. Now, with gold miners, the first thing you have to do is you have to like gold. And we do like the outlook for gold just now because obviously in the immediate aftermath of the financial crisis, when QE became a mainstream tool, lots of people were very worried about inflation. They thought it would really take off. And it hasn't really. But what we're really seeing in the last year or so has been big economies, the US, UK, and elsewhere, basically saying, look, government deficits don't matter. We're going to spend money. And the politicians are becoming round to realizing that if they don't spend some money, their successor from a rival party will do it anyway. So they might as well spend money, create jobs, whether it's a good idea or not, they're going to do it. And the market is just starting to waken up to this new world of deficit spending. There's no plan to balance books in the future. So that's gold. So that's why we like gold. Gold miners, well, these companies used to be really difficult to get exposure to gold. Then along in 2004 came the gold ETFs. The gold miners had been run quite badly, really, because they were scarce assets. They didn't need to be run as proper businesses. Now they are. They're merging. They're running themselves as you would with any other operating business. And we see them doing well in the future, assuming that the gold price is supportive as well. But as I say, we do like the long-term outlook for gold as well. And the things that maybe have lagged in the last few months has been oil. Now, oil clearly is exposed to, demand is exposed to the outlook for the global economy, and people have been a bit more subdued about that recently. The other thing with oil is there's a supply question. How much supply is out there? There's a new source of supply has reached the market in the last few years from US shale. Although, to be honest, at these sort of prices, it's kind of marginal. And then you've got in the Middle East, you've got a variety of geopolitical factors that could disrupt supply. But the real reason we like oil, and particularly the oil majors, is got nothing to do with the oil price as such. It's more to do with the fact that these are very cash generative companies that no longer have to spend crazy money either looking for oil or paying for oil services. They've got big dividend yields. They've got big plans to return capital to shareholders. And we see over the next few years them being able to execute on these plans, not quite irrespective of the oil price environment, but they could weather significant volatility. So that's why we like the oil majors. Well, I think I've mentioned, we've got interest in gold miners and in the oil majors. I think another areas of the markets we're looking for is areas where you get more stable earnings, such as telecoms in Europe, where they aren't as sensitive to the economy. So if there is an economic slowdown, the revenues won't necessarily decline that much. But what we do when we look around the markets is a lot of companies that people will buy, the products people will buy regardless of economic situation, they've actually done very well, and they're valued on very high multiples, very high prices as well. The European telecoms in particular are interesting because they've been in a bad situation really for 20 years, ever since the dot-com era, when governments were very keen for them to build networks. They built the mobile phone networks, and then the regulatory cycle turned really harsh. They've really struggled to make a significant return in recent years. However, there's a whole new wave of investment required, particularly 5G networks. And there's just the first signs that regulatory cycles are starting to turn, because basically governments want these networks built. And the way you do that is you incentivize the operators. So we think these are stable revenue businesses that are actually quite out of favor with big dividend yields.